Australia expected to hold. We're also expecting Malaysia to hold this week, but really a different story when it comes to the Fed or the ECB or the BOE next week as well. How do you play this policy divergence?
Sure. So I think that, heading into this year, one of the things to note is that the developed market is led by the U.S. It's really a different part of the cycle compared with markets here in Asia. Here in Asia, we've been kind of in a growth slowdown mode for quite some time. But in the U.S., I think if you look at wage growth, if you look at consumer spending, if you look at even the housing market, it's looking like it's bottoming. So they're still, I think, overall in a more heated territory from an economic cycle perspective. So that's one of the reasons why we've been quite reluctant to, I think, short the dollar across a range of currencies, basically since when the Fed started hiking rates. Because the ideas are, first of all, when the U.S. economy, let's say, goes into a monetary policy-induced slowdown, that will probably mean that the global economy will edge down as well. An accident can happen, and that causes risk aversion on behalf of investors, which actually strengthen the dollar. And then you have those interest rate differentials. Dollar is basically one of the highest yielding currencies at the moment, at least in developed market, amongst major currencies. So these are the reasons why dollar has been quite strong. I think that one of the things that are changing at the margin is that we're starting to see maybe the Fed is is closer to the end of their rate hike cycle. Maybe in the next couple of months, we will see those terminal rates being reached, and that could give us a different, I think, type of environment to play in.
Julia, there are a lot of questions over the direction of China's economic recovery, right? It seems very bifurcated with services and consumption versus the weakness that we see in investment. Property obviously still recovering and the industrial manufacturing side. Which way does it play out? And I guess, how do you best get exposure to the bullish parts of it? Do you expect that next leg of the rally?
So I think China's recovery is very multi-speed in the sense that there are clearly parts of the economy that are recovering as expected. So, for example, service sector consumption is rebounding during the May 1st holidays. On the other side, you can clearly see that goods spending is quite modest. It's probably some substitution, in fact, going on where consumers are prioritizing their service sector experience going on a holiday rather than spending on goods. And the housing sector, I'd say that the data look like it's bottoming, but clearly the spillover effect on consumer sentiment, household confidence, and business confidence is still quite evident. So I would say that given that we don't expect a big policy stimulus next couple of quarters, it's really a very organic recovery, and we would prefer to have exposure through some selective equities or fixed income where we know that, for example, the service sector is still an area where we like. We think that there's a little bit more room to run there, but we would probably avoid those very cyclical parts of the economy where we think that maybe the momentum is heading for a slowdown. On the export side, for example, clearly the strength of the March number, I don't think can be repeated. So these are the areas probably we'll look to avoid.
What about allocation to tech, just quickly?
So we still think that in the Asia space, the valuations are undemanding. I think that probably earnings have bottomed. So we do like it from a long run perspective. But we do have to be mindful of the fact that when we have those high interest rates, global sentiment can be quite sensitive to that. So the external environment does matter when we think about investing in China tech or Asia tech names. So I think that maybe there could be opportunities for pullback where we can buy those at more attractive values.